What if the most important financial shift of your lifetime is happening right now, and almost nobody on mainstream television is willing to say it out loud? What if the thing you were told was just a shiny rock, a relic, a dead asset collecting dust in some vault? What if that thing just stood up, looked the United States dollar dead in the eye, and said, "Your time is running out"? Because that's exactly what's happening. And if you've been watching gold's relentless climb over the past few years, if you've watched it punch through level after level that the experts told you it would never reach, if you've watched it move with a kind of quiet, unstoppable confidence that very few assets in history have ever displayed, then you already feel it in your gut, even if you can't quite put words to it yet. Today, I'm going to put words to it for you. Gold is currently trading at levels that would have seemed almost science fiction not that long ago. It has climbed into territory that retirees who bought gold in the early 2000s have been dreaming about for decades. And here's the thing. The people who understand gold the best, the central banks, the sovereign wealth funds, the institutional buyers who operate in the shadows, the nations that have been burned by dollar dependence, they are not selling. They are buying at a pace that is genuinely staggering, record-breaking pace. And that's not an opinion. That's a documented, verifiable fact that has been confirmed by the World Gold Council and every major commodities research desk on the planet. So let's talk about what's really going on, because this story is much deeper than a price chart. Before we get into that, though, if you're someone who has worked hard your whole life to build retirement savings, and you're starting to feel anxious about what's happening to the purchasing power of your dollars, check the description below. I put together a free guide that walks through the savings strategies that thousands of American retirees are quietly using to protect their hard-earned wealth right now. It's completely free. It's in the description, and it takes about 10 minutes to read. Check it out, then come back, because the rest of this video is going to make a lot more sense once you understand the playbook. All right, let's go back to the beginning. Not the beginning of this bull run, the beginning of the entire monetary system you've been living inside your whole life. Because to understand why gold is sending this message to the dollar, you have to understand the relationship between gold and the dollar, and how that relationship has been slowly, quietly, deliberately dismantled over the past half-century. In the summer of 1971, Richard Nixon walked up to a podium and made an announcement that changed the world. He told the American people, and more importantly, told the rest of the world, that the United States was temporarily suspending the convertibility of the dollar into gold. Every dollar in existence had been backed by a promise. You give us dollars, we give you gold at a fixed rate. That promise had held for over 2 decades under the Bretton Woods Agreement, and it had made the U.S. dollar the unchallenged king of global finance. Nations held dollars because dollars were as good as gold, literally. Nixon ended that. He called it a temporary suspension. It has now been more than 50 years, and it was never reversed. What he actually did was cut the last thread connecting your money to anything real. The dollar became, overnight, a fiat currency, backed by nothing but the promise of the United States government and the trust of the world. Now, for a long time that worked. The world kept using dollars, kept pricing oil in dollars, kept holding U.S. treasuries, kept trusting in the system. And America used that trust to do something extraordinary and something deeply dangerous. It began to spend without consequence. When you control the world's reserve currency, you can run deficits that would bankrupt any other nation. You can print money when you need to. You can export inflation to the rest of the world and let other countries absorb the pain. And for decades, the world accepted it. They accepted it because they had no choice. What were they going to do? Use the Russian ruble? The Chinese yuan wasn't convertible. There was no alternative. The dollar was it. But then something started to change. Slowly at first, almost imperceptibly. And then, like so many things in history, all at once. The seeds of what you're watching in gold right now were planted across decades of American financial policy. Each deficit a little larger than the last. Each debt ceiling crisis little more embarrassing. Each round of money printing a little more brazen. And the rest of the world was watching. China was watching. Russia was watching. The Gulf states were watching. Every nation that had ever been on the wrong end of dollar diplomacy was watching and quietly, carefully, drawing up contingency plans. Now let me tell you about something called the petrodollar system, because this is where the dollar's real power has always lived, and this is what's cracking right now. After Nixon severed the gold link, the United States needed a new anchor for the dollar. They found it in oil. In the 1970s, America struck a deal with Saudi Arabia, and through Saudi Arabia with OPEC. The deal was simple. Oil would be priced and sold exclusively in U.S. dollars. Every nation on earth that needed oil, which was every nation on earth, would need to hold dollars to buy it. This was the masterstroke. This was how the dollar maintained its global dominance even after it lost its gold backing. You didn't need gold anymore. You needed oil, and oil required dollars. That system has underwritten American financial power for 50 years. And for 50 years, the bill has never truly come due. But bills have a way of arriving eventually. And right now, the petrodollar system is showing cracks that simply cannot be papered over. Saudi Arabia has been quietly conducting oil trade in currencies other than the dollar. China and Russia have been settling energy transactions in their own currencies and in gold. India has been buying Russian oil in rupees. The Gulf Cooperation Council has been in active discussions about pricing mechanisms that bypass the dollar entirely. These are not rumors. These are documented, reported, confirmed policy shifts happening in real time. And when you start pulling on that thread, when the dollar's mandatory role as the oil settlement currency starts to unravel, you begin to understand why gold is moving the way it is. Because gold is the only asset that doesn't carry someone else's liability. The dollar is a liability of the U.S. government. A U.S. Treasury bond is a liability of the U.S. government. But an ounce of gold sitting in a vault in Warsaw or Beijing or Mumbai, that's no one's liability. It just is. And in a world where trust in dollar-denominated assets is quietly eroding, that matters more than most people realize. Let's talk about the central banks. This is where I want to spend some time, because what's happening here is genuinely extraordinary, and it's the clearest signal of all. Central banks are the most sophisticated institutional actors in the global financial system. They have armies of economists. They have access to information that you and I will never see. They manage trillions of dollars in reserves, and right now they are buying gold at a rate that is projected to break the record set just a few years ago, which themselves broke the record set before that. We are talking about somewhere in the neighborhood of 850 metric tons expected to be purchased this year by central banks globally. To put that in perspective, that is an enormous fraction of total annual gold mine production being swept off the market and locked into sovereign vaults. Poland, Kazakhstan, Uzbekistan, China, India, Turkey, nations across Asia, Eastern Europe, and the Middle East are methodically and relentlessly converting their dollar reserves into gold. Ask yourself, why would they do that? Why would a central bank, an institution whose entire mandate is to preserve the purchasing power of its national reserves, abandon the dollar and pile into gold? The answer isn't complicated, even if it's uncomfortable. They don't trust the dollar the way they used to. And when the most sophisticated financial institutions in the world lose faith in an asset, that's not a canary in a coal mine. That is the mine collapsing. Think about what happened in the aftermath of Russia's conflict with Ukraine, when the United States and its allies froze over $300 billion of Russian central bank reserves held in Western financial institutions. $300 billion gone, inaccessible, not stolen in the physical sense, but rendered entirely useless to their owner with the stroke of a pen. Now imagine you're the finance minister of any other country watching that happen. You had been operating under the assumption that your dollar reserves were safe, that holding U.S. Treasuries and dollar deposits was the conservative, responsible thing to do. And then you watched $300 billion get frozen in a matter of days. What do? You call your gold desk. You start moving reserves into physical gold held in your own country, because no one can freeze gold that's sitting in your own vault. And that is precisely what happened. The global shift into gold accelerated almost immediately after that event, and it has not slowed down. There's a pattern here that repeats throughout history, and it's worth walking through it carefully, because understanding the past is the only way to understand what's coming. In 1980, gold reached a peak that seemed absolutely stratospheric at the time. The late 70s and early 80s were a period of crushing inflation, energy crises, geopolitical chaos, the Iranian Revolution, the Soviet invasion of Afghanistan, stagflation grinding the American middle class into dust. People were scared. They didn't trust paper money, and they ran to gold. When the inflation was finally brought under control through brutal interest rate hikes by Paul Volcker, gold corrected sharply and spent the next 2 decades in the wilderness. But here's what most people forget. Even after that long, brutal correction, gold eventually surpassed its 1980 peak. And the move that followed, the move from the 2000 bull market through the 2011 peak, was one of the greatest sustained runs in commodity history. From around $250 an ounce to over $1,800, a 700% move over a decade. And then it consolidated, and now it's running again, this time with a fundamentally different backdrop. Because in the early 2000s, the U.S. debt picture was manageable. The dollar was still relatively trusted. The petrodollar system was still fully intact. China had not yet emerged as a genuine rival to American financial dominance. BRICS was barely a concept. None of that is true anymore. The national debt is now so large that the interest payments alone are consuming a meaningful portion of the federal budget, larger than the defense budget in some projections. Not the principal, the interest, the tab you run up every year just to service the debt that already exists. And that debt is growing. It will keep growing, because the political will to cut spending or meaningfully raise taxes does not exist in Washington and hasn't for a very long time. Now let's bring this back to the dollar, because this is the message gold is sending. Every time the debt ceiling is raised, every time the Federal Reserve expands its balance sheet, every time the United States government runs another deficit, more dollars are being created or backed by promises of future dollars. The supply of dollars grows, and when the supply of anything grows faster than the demand for it, its value falls. Gold doesn't grow like that. You can't print gold. You can't conjure it into existence on a spreadsheet. You can't decide one Tuesday afternoon that there should be 15% more gold in the world. Gold has to be found, mined, refined, and brought to market, a process that takes years and costs enormous amounts of money and energy. The supply of gold grows at roughly 1 to 2% per year, no matter what's happening in the political world. And that scarcity is not a bug. It is the feature. It is the entire point. When you hold gold, you hold something that cannot be diluted, something that no government can create more of, something that has served as a store of value for literally thousands of years across every civilization that has ever existed on this planet. The ancient Egyptians valued it. The Roman Empire valued it. The Silk Road traders valued it. The merchants of Renaissance Europe valued it. Your grandparents valued it. And the central banks of every major nation on earth are valuing it right now more than they have in decades. The dollar, by contrast, is just a promise. And the question gold is asking, the message it is sending with every tick higher, is how much do you trust that promise? Now, I need to talk about something called the COMEX, because understanding the paper gold market is crucial to understanding why the price moves you're seeing might just be the warm-up act. The COMEX is the primary exchange where gold futures are traded in the United States. And here's the thing about gold futures. For every ounce of physical gold that exists, there are many, many multiples of that in paper claims on gold, contracts, promises, I owe us, that say you have the right to receive gold if you want it. Most traders on the COMEX never actually take delivery. They're just trading the price. They roll their contracts forward and never ask for the metal. But what happens when they do? What happens when more and more buyers start asking for physical delivery? What happens when the gap between paper gold and physical gold starts to close? You get what traders call a squeeze, a violent, rapid repricing as the market realizes that the paper claims are worth more than the physical supply can support. And there are signs, documented, reported signs, that physical demand is straining the system. Refineries operating around the clock. Delivery timeline stretching. Premiums over spot price widening in certain markets. These are not signs of a market in equilibrium. These are signs of a market where the physical metal is becoming genuinely scarce relative to the paper promises written against it. The London Bullion Market Association, the other major center of global gold trading, has been under scrutiny for similar reasons. The system of unallocated gold accounts, where you technically own gold, but it's pooled and not specifically yours, has worked for decades because most people never ask for their gold back. But when confidence starts to erode, when people start asking questions about whether the gold they think they own actually exists in the form they think it exists, that's when things get interesting. I realize this is a lot of information, but I want you to sit with it for a moment, because what I'm describing isn't some fringe conspiracy theory. These are the mechanics of the global monetary system, documented and described by mainstream financial institutions. The Bank for International Settlements publishes reports on it. The World Gold Council publishes data on it. The Federal Reserve's own research discusses these dynamics. The only thing that makes it feel like a conspiracy theory is that most of the financial media doesn't find it useful to talk about, because talking about it would require admitting that the system has vulnerabilities that are deeply uncomfortable to confront. Let me talk about BRICS for a moment, because this is another layer of the story that most Americans don't fully appreciate. BRICS, originally Brazil, Russia, India, China, and South Africa, has expanded significantly and now represents a major share of global economic output and an even larger share of global population. And these nations have been quietly, methodically building the architecture for a financial system that doesn't depend on the dollar, a cross-border payment system that bypasses SWIFT, bilateral currency swap agreements that don't require converting through dollars, and increasingly, gold as the trusted neutral settlement asset for trade between nations that don't want to hold each other's currencies. The idea of a gold-backed trade settlement mechanism, where nations can settle trade imbalances using gold rather than dollars, is no longer the stuff of fringe economics journals. It's being actively discussed at the highest levels of these governments. China has been accumulating gold at a pace that suggests it's preparing for exactly this kind of world. The numbers that China officially reports are almost certainly understated. There's a long history of Chinese official gold figures being revised dramatically upward after years of quiet accumulation. Think about what that means for the dollar. Right now, the dollar's reserve status means there's an enormous artificial global demand for it. Nations hold dollars not because they love the dollar, but because they need it to conduct international trade. If that changes, if even a portion of global trade starts moving through gold-settled mechanisms, the demand for dollars shrinks. And when demand for dollars shrinks, more of those dollars end up back in the United States, which means more inflation for you and me. This is the feedback loop that keeps analysts who understand monetary history up at night. It's not that the dollar collapses overnight, it's that it erodes, steadily, quietly. And one day you wake up and your grocery bill has doubled from where it was, and your savings account is earning less than inflation, and the retirement nest egg you spent 40 years building is worth half as much in real terms as it was when you retired. That's not a hypothetical future. For millions of Americans, that's the recent past. And this is precisely why I want to take a moment to speak directly to those of you who are in or approaching retirement, because you have the most to lose from what's happening and the most to gain from understanding it. Look, if you have significant savings built up in a retirement account, whether that's a traditional IRA, a 401k, an SEP IRA, and you've watched the purchasing power of those dollars quietly erode while the financial press told you everything was fine, there is a way to get actual physical gold working inside your retirement account. Not ETFs that track the gold price, not gold mining stocks, not paper claims on gold. Actual physical gold held in a secure IRS-approved depository inside a structure that qualifies for the same tax advantages as your existing retirement account. It's called a gold IRA, and it's been around for decades. It was designed specifically for situations like this one. It's IRS approved. It doesn't require you to liquidate your existing accounts and take a tax hit. And if you have $100,000 or more sitting in a retirement account, it's absolutely worth understanding how it works. I've put together a free resource in the description that covers the basics, how the rollover process works, what kinds of accounts are eligible, what to look for in a custodian. No pressure, no obligation, just the education you need to make an informed decision. If it's not right for you, you'll know that after reading it. But at least you'll know. Because here's the thing. The time to think about protecting wealth is before you need to. Not after the crisis hits, not after inflation has already eaten through your purchasing power, not after you've watched your paper assets get hammered in the next market correction and you're sitting across the table from a financial advisor trying to explain why diversification didn't save you. The time is now, while you still have options, while the protection is still affordable, while you can still make the move on your own terms. And the move that central banks, sovereign wealth funds, and institutional investors have been making consistently for the past several years is buy gold. Let me come back to the technical picture because this is a market story as much as a monetary one. And the technical setup is fascinating in its own right. When you look at the long-term gold chart, I mean the really long-term, the multi-decade view, what you see is a series of massive consolidation periods followed by explosive breakouts. The 1970s breakout, the 2000 to 2011 breakout, and now this current move, each one driven by a different combination of factors, but each one ultimately rooted in the same fundamental reality. Fiat currency systems eventually force people back to real money. What's different about this particular move is the participation. In previous gold bull markets, the primary driver was individual investor demand. People like you and me who were scared of inflation and bought coins or bullion or mining stocks. Central bank buying was not a major factor. In fact, during parts of the 1990s, central banks were actively selling gold, which was one reason the price stayed depressed for so long. Today, it's completely different. Today, you have individual investor demand at very high levels, but you also have institutional demand, ETF demand, and central bank demand all operating simultaneously. You have demand from the East and demand from the West. You have safe haven demand driven by geopolitical uncertainty, and you have monetary demand driven by de-dollarization concerns. This is a much broader, much deeper, much more structurally sound bull market than anything we've seen before. And when you look at where the price is now and where the fundamental demand drivers suggest it's headed, the forecasts coming out of major banks and research institutions are not modest. Some of the most respected voices in macro finance have put 12-month targets at levels that would represent meaningful additional upside from where we are today. And longer-term projections, 5 to 10-year horizons, involve numbers that sound almost fantastical until you work through the math of what happens to hard assets when the dollar loses 20 or 30% of its remaining purchasing power.